want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Ask the Expert. I'm Emma Wall, and here with me today to talk about passive investment is Morningstar analyst Jose Garcia Zarate. Hello, Jose.
Hello.
So as part of our Financial Education Week, I thought I'd get you in to talk about what exactly is passive investing.
Well, passive investing is underpinned on the idea that active managers are highly unlikely to actually meet their targets over the long term. And therefore, for investors, it might be a better option to just track the market. And that's basically passive investment.
And there are a number of different tools that investors can use to do passive investing. Perhaps I thought we'd start with tracker funds. What exactly is a tracker fund?
A tracker fund is a mutual fund that is linked to an index, or basically that tracks the performance of an index. But it's pretty much the same structure as the usual bread and butter mutual funds that most investors would be familiar with.
So like any other open-ended fund, instead of a fund manager selecting a part of an index or stocks from an index that they think are going to outperform the rest, instead you just hold a proportion of all of those companies that make up that index, say 100 companies from the FTSE 100.
For example, or a selection in a bid basically to replicate the performance of the index.
And another type of passive investment that's become increasingly unpopular because of the low fee structure is an ETF. What exactly is an ETF?
ETF stands for Exchange Traded Funds. Again, we're talking about open-ended fund structure. The difference is that these funds trade on the exchange. So basically ETF. By trading on the exchange, what investors are able to get is actually real-time pricing. And that's basically the main difference between traditional index trackers and exchange-traded funds.
And what are the pros and cons of each? Does one type of vehicle lend itself better to a particular type of investment, say equities or commodities? How do they work?
The key difference is the trading element, obviously. As I said earlier on, ETFs do trade on the exchange, and that basically gives them a level of transparency in terms of pricing that traditional trackers do not have, because they settle the NAV at the end of the day. When you buy an ETF, you know exactly at what price you are buying, because you buy at real time. And that's, for some investors, that's actually a key advantage.
And there are certain markets where perhaps the less experienced investor would do better to outsource to an experienced fund manager, say Asian smaller companies. But for the broad, transparent indices, such as the S&P 500, passive investment is a very efficient way to invest, isn't it?
It's not just a very efficient way, it's a no-brainer way. I mean, even in the United States, you would be very, very hard-pressed to actually find an active manager that is able to beat the S&P 500. You are basically paying way over the odds by risking going down the actively managed road. The efficient and no-brainer way is basically buying a tracker.
And you mentioned there that magic word, fees, charges, costs. What is the difference between an active managed fund and a passively managed fund? I mean, what type of percentage point difference are we looking at?
There could be huge differences. I mean, the cheapest tracker ETF, actually, let's talk about ETFs perhaps, tracking or giving you the performance of the S&P 500 in Europe right now charges 5 basis points. That's the annual management fee.
And so for people who are uninitiated with basis points, that's 0.05%.
That's correct. Some actively managed funds can charge way over 1%. I mean, the difference is tremendous. And cost is the only element that an investor knows before investing.
Everything else is a variable.
Everything else is uncertain. The only certainty is cost. So the lower the cost, the higher the chances that you would actually get better returns. It's not rocket science.
And it's not just equities. We mentioned earlier that you can get exposure to commodities through ETFs as well.
Commodities, fixed income. There are close to 2,000 ETFs currently domiciled in Europe, and they offer you exposure to all sorts of asset classes.
Jose, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.